this is the full guide on how to pay 0% tax in Malaysia completely legally. My name is Leo. I help online entrepreneurs legally reduce their taxes by moving abroad. So what we're going to cover is going to be the company structure that we need to pay the 0% tax, a year split, so where do we have to be in the world, like physically, visa setup, what's the visa, banking setup, what banks do we use, where do we pay out us, like where do we pay ourselves from, what do we pay ourselves into, what money do we use for different expenses, and why this might not work in the future. So first off, company setup. And to understand this, if you know this, you can skip ahead a little bit, but there are two separate types of taxes, right? When you set up a company, you set up a completely different entity. So income tax is what you have to pay personally on your income, on your personal income, and this tax rate depends on your personal tax residency, what country you're personally resident in, where you have a house usually. Corporation tax is what the company has to pay on its profits, right? And the tax rate depends on where the company is resident, which basically means where you decide to set up the company. And this is the difference in the payout structure. I'm using UK tax numbers here because most of my followers are from the UK, but this applies the same way if you're Australian, Canadian. These numbers may be a bit different, but the payout structure is the same. If you're a sole trader, if you've got an Australian ABN, you are the business, so all the profits are attributable to you, and then you pay income tax on everything. In the UK, the highest rate is 45%. If you have a company, the company is the one that makes the profit. The company pays corporation tax, and then when you want to pay yourself out, then you pay yourself dividends, and then you pay taxes again on that dividend, this time personally. So again, to drive this home, when you have a company, you own the company 100%, but now the clients are paying the company. They're not your clients anymore, they're the company's clients, its own separate entity. Then the company pays corporation tax at 25% in the UK, and then you've got the profit after tax. Now, you may be thinking, I own this company, how do I access this money? And the answer very simply is you pay yourself dividends, which is a share of the profit, or all of them. And then on that dividend, personally, you have to pay tax based on where you are a tax resident individually. And right now, the highest rate for dividends in the UK is 39.35. So this is kind of the situation. If you take out the dividend at the highest rate, you're paying another 295 quid, and this leaves you with 454 pounds, whatever. Out of 1,000 that comes in, right? This is obviously at the highest level. There's ways around this to minimize the taxation, but like if you're within the UK, this is what's happening. And just to drive this home, imagine Tesla. Elon Musk, Tesla has its own revenue from selling cars, has its own costs, employees, staff, management, travel expenses, and the cost to actually buy the parts to build the cars. And then the difference is the profit, right? But then Tesla pays its own tax on its own profits with its own cash reserves. It's not Elon Musk that pays Tesla's taxes. And this time, once Elon Musk takes out money, then he pays taxes personally, but only on the dividend, only on the money that he took out. So right now, you're probably in one of these two situations. You're a sole trader, or you have an ABN, or you've got a company, and this is the tax structure. And this is how much you're paying if you're from the UK, if you're from Australia, Canada, Italy, France, it's probably going to be something similar. And obviously we work remotely, so in the ideal scenario, and we're going to get to Malaysia, right? We have a company because of limitation of liability. You can't be sued personally. Your personal assets are completely protected if you have a limitation of liability. And ideally we want this company to pay no corporation tax or 0% corporation tax. And ideally, when we do take out the money, we also want to pay 0% income tax or dividend tax, right? So how do we do this? Step one is we set up a company in the United States. Again, this may depend on your situation. Hong Kong may be better for you if you're doing e-com or drop shipping, for example. Cyprus may be better for you if you're in Europe, Estonia. So it depends. We're in Malaysia right now, so a US LLC works pretty well. And the US company pays no corporation tax. If you're the only owner, the US LLC works as a pass-through entity. It's transparent for tax purposes. So all income you receive is taxed based on where you are a tax resident. So you know how I just showed you before that the company pays its own taxes? Well, the US flips it on its head and gives you the best of both worlds. They're like, fine, we can give you limitation of liability. This is still a separate entity, separate legal entity to you. But if you're the only owner, you can decide to be only taxed once. So the US says the company doesn't have to pay taxes, but you sort out your own taxes based on where you are a tax resident of. So basically the LLC pays no corporation tax, but then the owner is liable for the taxes of that company, whether they take them out or not. Okay, that's the most important thing that a lot of people miss. They say, I can keep my money in the company. Well, you can't, because it's transparent. So all the income passes down to you anyways. And then if you're a UK tax resident, you're still going to have to pay UK taxes. If you're a Thai tax resident, you have to pay Thai taxes. If you're a Malaysian tax resident, you have to pay Malaysian taxes, right? So, but as I mentioned, if we're still UK tax residents, we're still paying 45%. So step 2 is we get out of the UK tax system into the Malaysian tax system and pay no tax on income as well. So how does this work? Malaysia has a territorial tax system. So what does this mean? They only tax you on money that you source from their country. Basically, if you don't make anything in Malaysia, they don't have anything to tax because they're not going to tax it. They're like, the UK and Australia, European countries, they're like, we want to tax you everything you make. If you pay taxes with us, you have to pay taxes on your crypto, on your business income, if you've got rental properties abroad, if you've got dividends from outside. Malaysia says, actually, we don't think that's fair. We only want to tax you if you make money locally from Malaysia. You know, we've got a Malaysian coffee shop, and I'll get into what it means to make money in Malaysia. Just bear with me. I'll tell you how to get out of your home country's tax system into the Malaysian tax system. But just so you understand, obviously this was the ideal scenario, and here's how we're recreating it. So this is the current scenario. Sole trader, you're paying whatever taxes. And in the new scenario, you pay no corporation tax because of the US company. It pays no corporation tax. Remember, all the profits of the company you are liable for now with the LLC. And then when you take out that money, it is also not taxable because Malaysia has a territorial tax system. So as long as you don't make anything in Malaysia, and again, we're getting into this right now, you're not going to pay any taxes in Malaysia either. So £1,000 comes in, no corporation tax. £1,000 comes out to your personal account, no income tax because it's not made in Malaysia. Now, let's go back to here, and how do we do the first two, right? Get out of the UK tax system, get into the Malaysian tax system. So that brings us to a year split setup. Like, where do we spend our time? Because a lot of what determines tax residency is the days that we spend in a country. If we spend over 6 months in a country, usually we're a tax resident of that country. In fact, pretty much always. So get into the Malaysian tax system. How do we do that? Very simply, there's a rule where if you spend 182 days in Malaysia within a tax year, you're a tax resident of Malaysia. As simple as that. Now you may say, but what if I don't want to spend all this time in Malaysia? Well, that's when residency, the civil concept of residency comes in. If you rent a property for 12 months, you open bank accounts, you've got a visa that allows you to live there, your center of interest is in Malaysia. Even if you spend a couple of months, a year in Malaysia in your flat that you rent, that's still your main residency. If that's your only house, you don't own anything or rent anything back home, this is still your main place of residency. So even though Malaysia might not even want to tax you if you stay that little, that's your residency and your home country needs to accept it. Obviously, provided you've left your home country's tax system. So how do you get out of your home country's tax system? This is step 2. And if you spend less than 90 days in any country you have a passport from, so your home countries. Now, this is not entirely true, and it depends a lot by what country you're in. In the UK, usually less than 90 days is fine, but there's a test called the SRT, the Statutory Residency Test, that you need to take to make sure that 90 days is okay. Sometimes you can get away with spending less than 120. Sometimes it needs to be less than 45, so be careful. In Australia, for example, they actually want to see that you're living somewhere else. So in Australia, it's a lot more broad. They look at like where your bank accounts are, where your family is. The UK is very clear, you're in or you're out. Australia have a much broader test, and they want to see that you've actually relocated, that you're not really banking there, you don't really have family in Australia, you don't really have stuff in Australia, and you've established a new house somewhere else. You're probably going to need a 12-month rental apartment somewhere else than Australia to actually get out of the Australian tax system. So this will depend based on what your home countries are. But generally, if you spend less than 90 days and cut as many ties as possible, this is going to be fine. And then less than 183 days in any one single country. This basically means stay out of any other country's tax system. We obviously want to get into Malaysia, out of your home country, and then we want to just stay out of every other country, because like it's all fun and games. You spend less than 90 days in a home country, We spend a couple months in Malaysia with a new house in Malaysia, but if we're then spending 7 months in, I don't know, France can taxes and all this stuff goes out the window. So this is the year split setup. And now next question is, what's a territorial tax system? Like, what counts as make money in Malaysia? So we're out of the UK tax system or your home country's tax system. We're into the Malaysian tax system. And now let's make sure we can pay 0% tax within this tax system, because a lot of people think there are no taxes in Malaysia, in Thailand, in these countries. It's actually not true. The taxes are even relatively high. They just decide what to tax in a different way. They don't tax everything. They only tax certain things, what you make in Malaysia. So what counts as making money in Malaysia? Obviously, you're working online, and there's two things really. Either you physically run operations in Malaysia, so you take a sales call, you do management, you have board meetings. Obviously, if you're watching, you're probably not at the stage where you're having like proper board meetings, but this is what counts. And second off, physical office space or employees in Malaysia, so locally sourced income. Right? If you've got a physical office space, if you've got employees, that's clearly income that's sourced from Malaysia, right? You've got people doing the work in a country, you can form a permanent establishment there. That becomes a problem. So you may be thinking, what about in practice? I actually do take sales calls. Like, what if I want to take sales calls there? What if I want to manage my team? If I actually want to work? And that's a big gray area, right? So first off, we can just rule out physical office space. Realistically, you're not going to rent out physical offices. You're not going to buy real estate. You're probably an info, right? Or a fitness coach or something, or a sales rep. You're not going to have employees, right? If anything, you're going to have contractors, and that's completely fine. So the only thing you need to be careful about is running your operations in Malaysia. So like sales call management in KL. Now, the tax system and the tax rules, tax laws are quite outdated, because technically this counts as making money in Malaysia. If you spend 6 months a year in Malaysia and you just work on your business, like, that's locally sourced income. That income should be taxed in Malaysia. Now in practice, obviously, if you don't really have operations, if you don't have a brick and mortar store, if you don't have employees, which is how traditional business was, right? This is all new, so regulations, the tax laws are still catching up with the present. These technically are taxable in Malaysia. So I will show you a better way of doing it with the LLC. But bottom line is, if you spend a month or two in Malaysia, then you're more than happy of paying taxes on that month or two. Obviously, you've got expenses. You can build your argument in a way that you only pay taxes on the time you were in Malaysia, or maybe like if you took sales calls in Malaysia, like that's the only income source from Malaysia. And again, I always like to pay some tax. I know this video says 0% tax, but it's like, obviously it is possible, but I always recommend paying some tax so you leave a footprint. And the other thing, if you spend over 6 months in Malaysia, then that's when you need to be a bit more careful, because Malaysia is not as far behind in infrastructure like Thailand or Indonesia. So if you make a lot of money, they're going to catch on. So I'll show you a better way of doing this, but this is something you need to be careful about, physically running the operations and managing the operations in Malaysia, especially if you're like a sole owner, right? If you don't have business partners. So visa setup, this is again very simple, remote worker visa. This is what it's called. It gives you a 2-year access to Malaysia, I think 12 months, and then you can renew it for another 12. It gives you permission to work with your online company. You don't need to do visa runs, and it's very cheap, right? $250. You don't even need to do anything else. You're not getting employed in Malaysia. You're not really investing in Malaysia. Maybe you are, but then this video is not for you. And then the banking setup. So visa setup, remote worker visa, easy. Banking setup, how does it work? So profits from operation. I'll show you the 2.0 version of this. We have our LLC that makes money, revenue, and then we pay for business expenses, mentorships, client dinners, flight tickets. If you rent out a nice villa, like for content, we pay for all the business stuff through the business card. And then with the money that's left, we pay ourselves 2 to 5K USD to our personal Revolut, to our spending account, let's say, where we use it for day-to-day spending. Grab our healthy food spots, if you have a gym membership, our basic rent. And I know if you're thinking you need more than 2 to 5K to live on a monthly basis, you probably don't. You're an online entrepreneur. If you have business expenses, if you have like client dinners, if you're renting out villas for content, like you can pay for it through the US LLC. Again, this needs to be business expense, be careful. But generally for day-to-day spending, like food, gym and rent, like 2 to 5K is gonna be more than enough, okay? And then the rest, so let's say you have 30K revenue, maybe 15K in expenses, and then 5K to live on, you're left with 10K, and then you split it 20% to your Malaysian bank account, It's okay banking in Malaysia. Again, it's not as bad as like Thailand or Indonesia, but I wouldn't keep too much money there. I'd use it for some day-to-day spending just to have it as a Thai. And obviously you have to keep your money in Malaysian ringgit, which is not the best. And then the other 80% you send to your home country's bank accounts. You park your money in here. This is money that we don't use. We invest into assets from this. I'm not saying keep your money in the bank, but if you're investing, I would invest from that home country's bank account. And that's because it's got the most stable banking. The banking in your home country, like if it's Australia, if it's a European country, if it's the UK, is probably better to keep the money over there than it is to keep it in Malaysia, right? So this is the profit split and how I would move my money around. Now, maybe thinking, but what if I'm from Australia and I don't want to keep all my money in an Australian bank account? And that is completely fair, because that is an extra tie that you have to Australia. That's an extra tie you have to your country, and it can be used against you for tax purposes, right? To claim you back as a tax resident. So a better setup would be to send your money to a US bank account. This is not easy to obtain. Like, you need to apply for an ITIN, you need to fly over to the US. It's not easy, but if you can get a US bank account, basically that wipes out completely your need for a bank account in your home country. You can just use a bank account in a third country, not your home country, not your new country of residence, just a third country that you just use for banking. That's great. That's what all the rich people do. So this is the banking setup. And this is why it works right now and why it might not work in the future. So first rule is management and control. And the second rule is source income. So management and control basically means a company is taxed based on where it's managed and controlled. And obviously, if you live in Malaysia, you're the only owner, you're the only director, you're technically managing the company from Malaysia. Now, it's not really enforced at the moment because you've got no offices or employees. Again, as I mentioned, remote work only really popped off after COVID. That's like, 5 years that it's been. So they're not really looking at this yet, because management and control, they just think about offices, they think about employees, they think about board meetings, like we're just on a laptop working away at the beach or at a coffee shop. So even though technically we're managing and controlling the company from one of these countries, especially in Southeast Asia, because in Italy and in Europe and in the Western countries, it's a lot harder. They're already getting you for this. But like in Southeast Asia, it's not generally enforced. And the second thing is source income. If you have a permanent establishment, they say, okay, fine, this is a foreign company, but actually this income is sourced from Malaysia because the company has actually been doing business in Malaysia. And physically you are there. If you are there, then this may apply to you. And the reason why it works is because obviously with the visa that you're there, they assume remote employment and activities. Like, sure, you can be an entrepreneur, but they just assume that your taxes are sorted out somewhere else, if that makes sense. So like, it's a territorial tax system. This guy works remotely for another company. He's probably paying taxes somewhere else. It's a territorial tax system. They won't tax you on your income, on your wage, on your salary. Obviously, if you're an entrepreneur, you don't really have salaries. You can have salaries, but then you pay yourself dividends and other stuff. So it's kind of a new situation. But these are things that, like, quite possibly, if someone from the Malaysian tax office looked at it, and they knew that the laws like properly, that they could tax you for this. Like if you spend 6 months in Malaysia, obviously depending on the volumes, and you're just managing your company and you're the only director, they could quite possibly tax half of your income. Not at 50%, they've got their tax rates, but they could. So this is why I've come up with an extra layer of protection. So this is like the 2.0 version of the US LLC. And look at this. So before we had the US LLC, we worked for the US LLC, we owned the operating company, and we're making money from there, and then we're paying ourselves. Now, if this is the case, then obviously there are these problems, right? Source income is sourced from Malaysia. Management and control, the company is managed from Malaysia because I live there, right? Because the owner lives there. But here's the deal. Our V2 structure still has the US LLC, but this time the US LLC is owned by a holding company in Hong Kong, and then you own that Hong Kong company, again, as a resident of Malaysia. So how does this work from a tax point of view? In practice, the US LLC makes the money. It's the operating company. It's the one with the stripe. It's the one where you receive payment. And then that money flows up to the Hong Kong holding company. It's either a dividend or a drawing, but it goes up to the Hong Kong holding company. And then the Hong Kong holding company, they actually have a tax rate, but they also have a territorial taxation basis, which basically means if you're not making any money in Hong Kong from Hong Kong, they also don't tax you. So basically the LLC pays 0% tax because it's transparent. The Hong Kong company pays 0% tax because you're not making any money in Hong Kong. And now, instead of paying yourself drawings, you're paying yourself dividends, and dividends are passive. So there's two reasons why this gives you an extra layer of protection. The first one is because now you're getting paid in dividends and not in drawings. Dividends are historically just passive income. It's money that you're taking out of profits, and it's just a passive distribution, whereas from the LLC this is a drawing. So that's the first reason. Obviously, if it's passive income, it's obviously harder for Malaysia to argue that you've sourced that income from Malaysia, because no, you're just receiving passive income from an offshore company, so they're not going to tax that. And the second reason is because now you don't even own the LLC anymore. Like, you can't manage a company if you're just an employee. Well, you can, right? But in Malaysia's eyes, you're just an employee of the LLC. Like, you can just show them an employment agreement with the LLC. They don't even know who owns the holding company in Hong Kong. If you pay some taxes, which again, I always recommend you do, you're just going to pay taxes on your employment. Let's say you pay yourself like $1,000 a month as a salary. That's sourced from Malaysia because that's where you're working, that's where you live, and that's completely fine. But then the bulk of your income is from dividends, which are passive, which are not taxed in Malaysia. So this is the structure. I hope this helps. That's it. If you want me to help you put this system in place, you can book a consultation call with me using the second link in the description, or you can click the first link in the description. That's a link to my free tax masterclass for online entrepreneurs. That's everything that you ever need to know on paying taxes as an online entrepreneur. See you. Thanks for watching. Bye bye.